Hello, everyone. John Flynn here from Flynn Real Estate, serving Southern Ontario, based out of the Niagara region. Thank you once again for tuning in and Happy New Year. Actually, was it a Happy New Year? I noticed this New Year's Eve, there wasn't a lot going on, especially in Canada. I usually take it easy with the family. I sit at home, watch TV, watch the ball drop or the countdown or whatever the case may be on TV, YouTube generally, because there's a lot of live streams. They have usually them from all over Canada, from CTV News, CBC, whoever, right? This year, I couldn't find any. I don't know if it was just in my area, but again, I'm from Ontario, but Niagara Falls, they used to have concerts every year for 30 years, and it was canceled during the pandemic, and they never revived them. A lot of the hotels and the local businesses, they have to contribute along with the region, and I think even the province may contribute. But regardless, the funding has stopped this, so they've never brought them back after the pandemic. And as many of you know, you probably watch on TV at home also the Niagara Falls events over the years that have happened. Well, that doesn't happen anymore. And that's just one thing. But again, I'm searching on YouTube and I couldn't find anywhere. In Montreal, they have canceled the fireworks permanently there. So no more New Year's Eve fireworks in Montreal. And then, of course, I don't know if you read the news about the CBC. The CBC, it wasn't in their budget, or they didn't have the funding to cover New Year's Eve this year. I guess we give them $1 billion, but it's not enough. They could not cover New Year's Eve. So kind of a trend, lack of funding to celebrate New Year's Eve from these locations and companies. So I found that very interesting this year. I really noticed it again because I was searching for somewhere to watch. I had to watch New York City. There was really nowhere in Canada to watch, and no big outlets had anything. It was like a ghost town when it came to New Year's Eve. So I think this may be foreshadowing what could be happening in our economy. But let me get into some charts. I have some really interesting charts this week, and I'm going to start warm up with just a few here from my system. First up, we have the number of sales, of home sales, over $1 million by year. Of course, you could see as the years went on, this is a 10-year chart. 2021 and 2022, we had a massive increase in the $1 million sales. Of course, everyone became a millionaire with the pandemic and the stimulus. And if you look at now, 2023, or last year, I should say at this point, we have dropped right back down to around 10,000 sales, but that number will most likely continue to drop. So it just goes to show you the market is trending away from those higher price sales, and this is in the ITSO 20 board surrounding the GTA. Here's the same data, but by month instead of by year, and only going back to the beginning of 2021. And you can see, of course, it did trend up with 2022 being the peak. It looks like it's March, maybe February or March there. And now we're having less sales, or in 2023, I should say, we're having less sales over $1 million than we did in 2023. And December actually had the fewest sales over $1 million than it did for the last 3 years. Now looking at the other end of the spectrum, sales under $500,000, which of course have dropped off because prices got higher. So here are the home sales under $500,000 by year. Again, this is the 20 boards surrounding the GTA. And of course, as time goes on, there's less and less sales as houses got more expensive. 500,000 back in 2013, there was lots of sales, just under 70,000. 2015 and 2016, there was actually more sales as prices were increasing. There was actually more sales under 500 in those years, and it drops off as time goes on. And of course, 2022, very few sales. Well, there were still maybe 10,000, probably a lot of condos and whatnot in there. But 2023 started ticking back up. So those lower price sales are coming back, and I expect that trend to continue into 2024. Now, the next data I'm going to show you, it's a lot of charts, but I compiled it. This is all raw data I compiled on bank interest rates, or Bank of Canada interest rates, unemployment rates, and house prices that are all tied together. The cycles are all tied together. And I just wanted to show how the cycles work and the similarities. So it's not a prediction. These are actually cycles that happen, economic cycles, and we're going to go through them just to show you, where I'm coming from when I'm making my predictions and, estimating or predicting what might be happening in the future and at what point, and how I'm getting this data. So I've gone through this before. maybe last year, but I think this might clarify a lot more and break it down with specific times that I'm going to compare it to. Anyway, let's check this out here. Now, I have three time periods for the unemployment. I have back from 1986 to 1992, which was, of course, the big cycle when we had the big inflation. We had big inflation, house prices ran up, and then the economy slowed down and there was a recession. I'm going to use 2004 to 2009, or sorry, 2005 to 2009. We didn't really get hit too bad in that economic downturn, but I'm going to use a little bit of that data and, of course, comparing it to today. So here is the Bank of Canada rate versus the unemployment rate from January 1986 to December 1992. And you can see the Bank of Canada, the interest rate there, the overnight lending rate is in blue. And as that starts to go up, the unemployment, of course, is low. It's actually trickled down a bit. But as it peaked and the rates started to come down, meaning they did their job, they slowed the economy, the unemployment starts to tick up. And of course, rates came down, unemployment went up, and which generally would mean a slowing economy, which did happen at that point. Now, looking at the same data, but from 2005 to 2009. So they put the Bank of Canada rate up. Now, there wasn't a huge swing in the rates back then. Again, we got off easy, but you can still see the trend. We started, 2.5%, and it went up to 4.5% or so. And it didn't take too long. There was a little bit of a lag here, but from just before 2008, they started to drop. And of course, unemployment started to tick up and rates went down. Unemployment continued trending up with that lag time in there. And here we are today. So on the left side of the chart, of course, that was the unemployment coming down from the pandemic, which was really not a realistic unemployment spike because that was forced closures and layoffs. That wasn't part of the normal cycle. But the normal cycle is starting, from January 2022 when they started to raise rates. And of course, they have the rates throughout their hold period right now. And unemployment still relatively low, ticking up a bit. But when they start to cut those rates, as I claim, those rates will start to come down on the blue line and the unemployment will go up. And that's all part of the cycle. Now I'm going to compare the house prices to the Bank of Canada interest rates, which I do normally, but let's do this again here. So here is from 1986 to 1992, and this is the Toronto Real Estate Board data for freehold prices. I have to separate them because, I don't have to separate them. They're separated on the system, so I have to use one or the other. I'm obviously not going to use condos over freehold, and I didn't do two sets of data because I had to manually pull all this information month by month. So anyway, here are the average freehold prices. You can see in the green line, but as the house prices were going up, they started to raise rates to cool the economy, and maybe they did it to do with house prices, or maybe it had some correlation to house prices, but they're all intertwined. So of course, the interest rates start to go up. House prices continued to go up with the rates, with that lag time in there. And when they started cutting rates there in the red, house prices were already declining before then because they had started to do their job, those rates. And of course, rates kept coming down all the way to 5% or so, and house prices continued along with them. Again, back to my argument, don't think because they cut rates, the housing market's going to take off. It's actually the opposite. There is a big lag time in there. This is the same time period, but this is the 20 boards surrounding the GTA, the ITSO data. They didn't have a big of a swing back then, but again, house prices were going up, rates started going up, and the rates started to do their job, and they had to drop rates down after that since they did their job, and of course, house prices came down along with the rates. So I did post this on X this week, and people said, well, this time's different because this time the house prices didn't go up with rates. Now, looking at this chart, yes, they are correct, but it's what happens after the rate cycle. The house prices and the rates prior depends on when they reacted. Now, as you all know, they should have started increasing rates right along that bottom of that flat line in about mid 2021 when inflation started to go up. But they didn't do that. They waited. And of course, prices got even higher because they waited with those ultra low rates. And that's why they increased quicker than they have in history, I believe. But it was within the last 40 years. It was one of the quickest rate hiking cycles ever. And you can see there on the magnitude of the steepness of that red line there. And of course, look what happened. The speculation hit the real estate market and prices dropped. Now we are all the way on the right side of this chart right now. Rates are still high. Prices are declining. So we do see the decline prior to the rates dropping, which happened again in 1989, 1990. And of course, once they start dropping the rates, you're going to see prices are going to go along with them. It's all part of the cycle. And here's that same data from the 20 board surrounding the GTA. It looks very similar to the Toronto Real Estate Board data. Again, they didn't increase rates quick enough. So, of course, prices rose without rates rising. But again, that is a mistake on their part. But we will see once they start dropping now, prices will continue to decline just like they did back in that 86 to 92 cycle. Okay, now let's put all this together from the last time we had a real cycle from 1986 to 1992 to see how it looks and to see where we are. So here it is. Here's the chart. The green are the house prices, and this is the Toronto Real Estate Board prices. Actually, let me put on the other one. I'm going to put on the ITSO, the 20 board surrounding the GTA. Not as pronounced, but you can see they're both the same cycle here. So here we are. We're at the top of the rate hiking cycle, the blue line. This was just back in, 1990, I believe this was. And as they started to drop, so we're not there yet in our current cycle, but look what happens. They start to drop the rates. The house prices continue to decline. They've already declined a bit. And of course, unemployment is relatively low. That starts to increase. So this is all part of the financial cycle. It just doesn't go up all the time. It can't happen, just like rates don't always stay low. They have to put them up, and this is what happens. And this is like a visual representation or visual data so that you can see. Now, I did update my home buying recipe, just updated it today with the latest data. Of course, prices are falling. That's good for home buyers looking to buy. That one's checked off. Falling rates. I did give it 1 bar of battery because we're at our hold right now. We've been there for about 5 months. We're at 5%. Because of all the talk and speculation and predictions from the markets and whatnot that rates will be getting cut this year and we're going to see 2 or 3 cuts, whatever the case may be, I did give it a battery bar there just because it's expected. It's most likely going to happen. I haven't even disagreed with this. I think if you're going to disagree with rates falling, you're probably on the wrong page. They are going to fall at some point. It could be later in the year. It could be early. I don't know when, but they're going to fall. So that is a good sign for anyone that's looking to buy a house or get into the market. High unemployment. We're not high yet, but it has creeped up since last time. Last time I did this, we were at 5.5%. We're at 5.8. When it gets to 6%, I'm going to add another bar to that battery. And of course, the mortgage arrears and delinquencies haven't moved, still very low. But of course, all that kicking the can down the road and negative amortizations and all the tricks that they're using is keeping that number low right now. But of course, it won't stay low once all the rest of these start to fill in. Now, lastly, I just want to read a few excerpts from this article from Dave Rosenberg. And he made a few good points in here. You can read the whole article. It's pretty technical if you're into investing and whatnot. I'm not going to bore people with that stuff. I'm not an expert on that and bonds and yields and all the rest. But I just want to talk or give a few points that he made that are very relevant. This is from the US, this talking about the Federal Reserve and whatnot. But you can literally just substitute in the Bank of Canada every time he says the Fed or the Federal Reserve, because it's exactly what's happening here. And we're hearing the same language and the same tone from the Bank of Canada as we are from the Feds, higher for longer and all the rest of this stuff. So here we have it. This is from the Financial Post on December 28th, 2023. David Rosenberg, why the so-called soft landing is just the calm before the storm. The biggest worry of the new year is that precious few investors are prepared for the inevitable downturn. Soft landing, just a bridge. This past year was also filled with economist after economist dropping the recession call and embracing the soft landing or even no landing economic narrative. So you have to be careful when listening to economists because they are employees or contracted in from corporations and companies and whatnot. So a bank, the bank's economists aren't going to give you a doom and gloom for the economy for that bank. They're going to sugarcoat it and make it seem like it's better than it is. They don't want to scare consumers, just like real estate companies. And of course, you have seen many real estate companies make predictions, and they hire economists to say, oh, we think house prices are going to go up because of this and that and whatever else. So they're actually using the economists to fill their narrative instead of being independent in what they do. Now, this guy, I believe, is more independent. He doesn't work for banks and real estate brokerages. He has his own company that does trading, but he's very sound in what he seems to say. For 2024, I sense that all this confusion will be resolved. We will realize that we were indeed in a soft landing, but then also recognize what soft landings really are. The bridge or transition from the expansion phase to the contraction phase of the cycle. We will see that a soft landing is not a permanent feature, that the business cycle has not been repealed, and that interest rates do matter, but they operate with long and variable lags. So, of course, he's talking about the cycle. You can't repeal the business cycle because it is what it is, and it goes through its phases. Right now, we're in a contraction, or we're going to enter into a contraction phase. To be sure, rampant debt finance fiscal stimulus helped extend the energizing bunny U.S. consumer in 2023, but that is now in the rearview mirror. What lies ahead is the ongoing resetting of the economy to the damage the Fed has already unleashed, as the Fed does what central banks do best, which is fight yesterday's battle. And of course, we saw that with the Bank of Canada. They waited too long to raise interest rates, and of course, they had to raise them extraordinarily quickly to fight the battle they just lost in 2021 when they should have been raising. Economists have prematurely declared the death of Mother Nature. In assessing the historical record, every recession has followed the proverbial soft landing. Think of 1969, 1979, 1989, 2000, and 2007. All were soft landing years that were followed by hard landing recessions that precious few investors were braced for. This is my primary concern today, the lack of preparedness for the inevitable downturn. In a pause period which started in July, and we have to keep in mind these periods tend to last 10 months, so we are now halfway through. So, of course, Canada is in the exact same situation. Our last rate hike was in July 2023, and we have been paused since. So, we were halfway through that 10-month pause. The Fed's higher for longer mantra was never anything novel. It has been a long-held strategy as the tightening cycle ends and the central bank is unsure if there is any more to do. The funds rate eventually peaks, and then, with an average 10-month lag, the easing cycle begins. Every tightening cycle in history has been followed by an easing cycle, and vice versa. So I think it's pretty hard to argue with what he just said with the basic fundamentals of a business cycle or a rate cycle. Rates are going to start coming down, and the rest of these things will play out like they always do. I think pretending that this time is different because of immigration and because of all these other things, it really doesn't matter. Interest rates dictate what's going to happen in the economy, and everything else follows. As always, let me know what you think in the comments, and until next week, I'll see you then.